So my name is Tene Williams. This presentation is going to show you something that maybe you know, maybe you don't know, but I think it's the best kept secret in just finances that I've ever seen. So first of all, my name is Tene Williams. I have been a real estate investor for 2 decades now. My earned income has been consulting. I was also a mortgage broker. I worked for a few mortgage banks. We've had a construction company. It's been awesome. I'm currently up to 47 apartments after 2 decades, and that's after losing a bunch after the crash, before the crash or during the crash. We lost a bunch, we gained it back. Perseverance is a real thing. And this is how it all started. I started at 19 years old. This is me at about 24 with my 2 children. I had those 2 boys at 16 and 19. And so they've always been by my side, on my hip, in the background, you know, just dragging them through. And, you know, it's been a lot of fun. I've also you know, basically, like I said, insurance. I have my Series 6 and 63. I've loved finance for some reason. Everything finance, I've been in that space because something clicked in my brain around 18 or 19 after selling cars. And I go, you know what? If I want to make money, why don't I just concentrate on money? And so that has been my journey. These are the children now, and it's all been about a legacy mindset. Simply, I didn't want those boys to grow up as being the boys that were on the corner and, you know, having trouble. And so I made sure that they grew up well in good neighborhoods and, you know, got to middle class. And I learned something at each and every stage. The thing about it, like I just said, success is not this straight arrow that everyone thinks. For some reason, everyone thinks that it's the straight arrow. I'm sure if you've seen this, you probably have seen this before on Facebook or on, you know, social media. This has been shared to you. That is really what success actually looks like. It's not a straight line. It's a consistent process of growth. And so what I'm about to share with you is something that I actually just only figured out about 1.5 years ago after spending just under 2 decades building my empire. So let's rethink real estate, okay? I want to share something with you about real estate that you may not have known. Most of us only know about buying a home. Okay, I want to get my first home because that's the home that my family's going to live in with the white picket fence. And if you love Instagram luxury homes, you might think you want that huge property that, you know, that the family's going to live in, and it's going to be your what do they call it? Your forever property. And so you're going to basically build equity with that. Most of us don't even think about, you know, the appreciation and how much the property is going to be worth. But I have to tell you, a lot of generational wealth is built in real estate, no matter which way you go. Most people that you find are pretty well off, or like 2nd, 3rd generation, they've owned their home. So that was a wonderful way to go. Having your own home, having your generational family home that you can pass down to your kids because you paid off the mortgage after 30 years, that's one way to go. Then you have your earned income investor. And so if you know anything or heard some clues, this and that about real estate, you might have heard about your arbitrage investor. Oh, you could make money with real estate and, you know, do Airbnb and corporate housing, and you could do stuff like that. You could also fix and flip. You could wholesale. I put all of those types of income in the earned income bucket. I don't think that those are actually building wealth. Those are actually just like being a realtor, and a realtor simply does sales. So you figured out, if those are that's what you're focused on, you figured out how to make an income from real estate, and that is an earned income. Then you have your investors that, you know, are like me and thought after a while, you know what, I figured out that fixing and flipping and wholesaling, all this stuff is just earned income. I want to be the person that's actually buying and holding these properties. So I have rental income, and now I've done it. Well, there's actually another thing. And so it took me over 15 years to figure this part out. After, you know, it sounds good, 47 apartments, but 47 apartments We've got those properties, with less than no money down, with veterans loans and FHA loans with 3.5% down. Also, by the BRRRR method, where I would find a property and fix it up. And then that was a great option. I thought that was the right way to go. And then now we've got equity in the property and we're renting it. But here's the part that I didn't get. I didn't get that there's a lot of work involved being a landlord, and it's no different than the earned income stuff. But, you live and you learn. So here's what's happened as of last year. I learned there was another bucket, which are those investors that are passive equity investors. And this is what we're going to be talking about today, how to invest as a limited partner in a multifamily property. Now, let me tell you, this information, when I went to the local REI club, or I went to local meetups, or, now we have Clubhouse, we have all of Instagram, people are not usually talking about this bucket. You have to be tapped into a very specific community to hear about this bucket. In fact, I had never really heard of it, and we've all been online for years now, until just last October, when I started to do research on how I could buy like a 10 or 20 unit apartment building, because I thought that's going to be the next level. But I learned something a little bit more. And that's where that real estate picture comes in. And so that success picture is like, you learn something and then you learn something else and then you learn something else. So let's think about building wealth, earned income. You make money. No matter how you make it, you're a professional, you're a doctor, you're a lawyer, you're a real estate investor. That's, wholesaling, flipping, fixing. You're a real estate investor, or you could be any profession, right? You went to school, you're like my brother, he's a wonderful engineer. I love him that he's an engineer. You could be a contractor, a developer. Now, what are you doing with your extra money for your retirement, or even just for your living expenses? Most of us, and when I say most of us, I mean a lot of us. It's like, I haven't looked up this figure yet, but I know I've seen the figure and it's like 90% or something. It's a high figure. Most people take their earned income, and everything that I've heard up until now is you take that money and you save it. Yeah, that could have been, did you hear, you make money and you need to save at least 6 months of your expenses. And if you can save 6 months of your expenses, you're pretty good. Well, I don't know how much money you're going to get in interest on that, but today's banks are not paying any interest, if any at all, on savings accounts. It's like 0.000 something, 0.0 something API. Okay, let's say you got a better account at the bank. You got a money market account. So your money market account is paying 2%. Great, 2%. Does that mean that you're going, what is 2%? A lot of us think about, okay, if I win the lottery and I've got, money sitting in my bank and it's at 2%, that's so much per month. I know I've had that thought before. Have any of you had that thought before? Please put a yes or no in the comments if you've had that thought that, if you win the lottery and you're getting XYZ percentage, that would be, you'd be good monthly. You don't have to work anymore. Then if you are a little smarter, just before the pandemic, I thought I was really smart. I mean, not the pandemic, 2008. I thought I was really smart by investing in mutual funds. If you have an IRA or 401k, it's probably invested in mutual funds. It may also be invested in the S&P 500. But here's what I found out about mutual funds. Mostly mutual funds are set up where they eat you to death. They eat you alive in fees. When it comes to stocks, they eat you alive in fees, your stockbroker. They make money if they buy or sell, if they make money for you or they don't make money for you. And I learned this lesson. I don't know if any of you have ever read Money Master the Game by Tony Robbins. It came out in 2009, right after the 2008 crash. And he basically exposed everything. And he said, you want to manage your own money. You want to get a registered investment advisor to handle your money. So if you're a smart investor, you're not in a savings account, you're not in a money market account, you might be in mutual funds. You might be even a little more savvy looking at real estate investment trusts. A real estate investment trust is, now you've gone up a little bit. You've got your equity in, invested in companies like Realty Mobile. They have a lot of online platforms that do that, but you're not going to get as much return on your investment as you can get when you're working with a private company like Clearview Eastern Fund. You could be, I had one of my old clients call me today. She goes, Tené, I need you to help me. I've got to raise 100 grand because I've got to get into this pre-IPO. And so I'm listening and I'm like, the pre-IPO, okay. Do you know who that is? I've heard this several times. Oh, I've got to get into this IPO. If any of you have watched that movie, The Wolf of Wall Street, when they used to sell those pink sheets pre-IPO, you're talking about a lot of risk, okay? And then you have the S&P 500. If you have a 401k and you know about index funds, you're a little more savvy, then you probably are invested in indexes and index funds, which is a great strategy. The average S&P 500 return on investment has been 10 to 12%, actually 10 to 11%. So anything that we do, we're always pegging ourselves against the S&P 500. If we could do better than the S&P 500 or close to it, it's a good investment. So let's, this is a disclaimer. I'm going to talk about our projections. I'm going to talk about the Clearview Eastern Fund, what we project when we buy property, how we buy property. We're going to talk about all of this. And there's a lot of forward-looking statements. So just to let you know, we are registered with the SEC as a 506C. And so that means we have the ability, this fund, we're a private equity fund, and we have the ability to advertise and things like that. And my financial disclosure is that we only are available to accredited investors, but don't get disappointed. I'm going to explain what that actually means at the end of the presentation. And I'm even going to show you there's a way that you can get involved if you're not an accredited investor yet. So hang on. If you have any questions, please go ahead and put it in the chat, okay? Because I will answer questions at the end of the presentation. So like I was saying, why investors like multifamily? Here's why I like multifamily, and here's why most of us like multifamily. We don't have the issue with it being such a time-consuming job. With multifamily, someone else is handling everything, especially with larger multifamily, and I'll explain that in a minute. We don't have to deal with management, so I don't have to deal with being a landlord anymore. I'm telling you, it's freezing right now. My son is in New Jersey. He just flew back from Dominican Republic. We've got Airbnbs over there. Since he left the Airbnbs over there that he's not present for, and he's got a decent staff in DR. Since he's not there, he's trying to figure out how to get one of the maid services paid. So he's got that challenge. And then he's got another challenge. He went back to New York. 3 boilers are on the blink. We're trying to find a freaking plumber in the middle of Christmas. It's not going to happen. These are the kinds of things that I found out there's another way. The other wonderful thing about investing in multifamily is I'm not worried about having to one by one find the right properties. Now we focus on buying duplexes, triplexes, and fourplexes for the last 6 years. We focus on that, and that's what got us such a high number quickly, because it's only 9 buildings, but each one is a bunch of apartments. So we've got 3 apartments here, 4 apartments there, 2 apartments there, finished basement there. So that's how we were able to get to that 47. But instead of just being focused on one market, we also, in multifamily, you now are not localized to your only market. And I'm going to tell you why that matters in a minute. You don't have the same concentration of capital all in one deal either. That's another thing I'm going to cover. Then, normally you're worried about your loan payments, you're worried about all of this kind of thing. When you're a multifamily investor, the only thing that you're worried about is how much your check is and how you're worried about your payments that you've got coming in every quarter or every month, whatever it is. So the Clearview Eastern Fund, our mission, first of all, we buy apartment buildings north of 50 units. So we don't buy anything less than 50, a complex with 50 units or more in it, with people who want to own and benefit from real estate without having to deal with any of the hassles. All those hassles I was just talking about, not a thing. That's not part of it. Our mission is we strive to be relentless in negotiating the best possible returns to offer our investors consistent cash flows that fund lifestyles for generations. And I'm going to go a little bit further into that. We help people and businesses worldwide realize actual true wealth And it's funny because it depends on what investor you're talking to, but not all investors think alike. For this particular private equity fund, for us, we are looking for legacy cash flow. And our investors are able to invest, receive their principal back, and still continue receiving cash flow. And I'm going to talk a little bit about that in a second. So, our core values, we want to deliver results with integrity and accountability. And our goal is that money can't buy everything, but cash flow at least buys your time freedom. So remember that analogy I was thinking about earlier. Oh yeah, if I win the lottery, your chances of winning the lottery and then getting, paid monthly income is like whatever, one in God knows how many, right? And what's interesting about winning the lottery is most people who win the lottery never invest properly because they don't have any wealth education. And that's why I was playing that video to get us started, because wealth education is not common. It's not something we learn in school. It's not something that, depending on your parents, you may have wealth education in your family, but it's not something that's common in public or private schools, not even in college. They may teach you how to, as a matter of fact, my daughter's 17, they're teaching her, I was really surprised and very happy that they are teaching how to manage a checkbook and a checking account, how to balance that out. And that's the extent of financial education. Also, I know that my school my son went to, they did have some business courses there, but one of the complaints that a lot of us complain about is the business courses at most schools are not taught by business owners. They're taught by people that are giving you theory. So wealth education is something you've got to go and seek and find. And most of the wealthy, if they didn't come from family members that already had something to pass down and a certain wealth of knowledge, that's where that book, Rich Dad, Poor Dad, comes in. It's two completely different ways of thinking about your money, thinking about your finances. So passive cash flow equals legacy. Okay, when I say legacy, think about people like we've all heard, like the Rockefellers or just look at Elon Musk. I mean, he's got 5 boys now. All his boys, he's got legacy cash flow. Okay, whatever he did, he's got all of this money in his businesses that'll be passed down to the kids. I actually wonder about Elon though, because he keeps saying he doesn't own any real estate. So I don't know what that means. But because if all of his companies crash, I don't know what those kids are going to have left. Is that possible for all of his companies to crash? Tell me in the chat if you think Elon could lose all of his businesses, because him as well as Amazon lost a ridiculous amount of money this year. And so when you think about your 401k or your mutual fund that's invested in the stock market, I want you to look at your portfolio and see how much money you actually lost this year. Did you actually lose money this year, or are you gaining this year? So that's the thing about the stock market, is it's based on the top businesses, especially if you're in index funds like we talked about with the S&P 500. You could be, with the top companies, and depending on the economy, it's fluctuating up and down, up and down. The other thing that we learned the hard way, because my son actually loves to trade options. He's into options. And he keeps going between options and real estate back and forth. And the IRS actually nabbed him in the butt because he didn't file taxes. They filed taxes for him and said that his margin account was the income that he made. Big tax problem we had to fix. But the one thing about the stock market is that stock market, you get no tax breaks. With this particular investment type, the government wants us to provide housing for your community. So when you think about, as a real estate investor, as of this week, for years, the government has, and when I say the government, I mean the IRS, which is actually not the government, but the IRS gives us a tax break for serving our community with housing. That tax break is called depreciation. Depreciation is I'm sure you've seen depreciation. Depreciation is on cars, on anything. But when we buy property, we get 100% depreciation up until Friday or Saturday. and then it will go to 80% depreciation next year. They're actually changing the tax code because so many people have made such a shit ton of money, excuse my language, by investing, the wealthy investing in vehicles like this, where they were able to accelerate their depreciation and get cash flow tax free. So that is a strategy that has been used by a lot of wealthy. And so let's look at this slide. Our ARR, IRR, that means our initial rate of return. We always try and make sure we have a minimum of 12 to 24% ARR, IRR on our properties that we're buying. We want to make sure that we can pay our investors 6 to 8% preferred returns. Preferred returns means we don't get paid as the general partners. We only own 30%. Our investors own 70%. As our investors that own 70%, you get from the net operating income of any property that we're buying in the portfolio, you get paid first. So we want to make sure that we hit that waterfall and you're paid first. And that's also all the tax savings. Many of these REITs and different types of private investors that you'll talk to that might be in the same business, they don't pass on the tax savings. We actually pass on that tax savings. So you can receive cash on cash flow every time you're getting that cash flow. It's tax free. Now that's something you're not getting in your stocks. That's something you're not getting on your earned income and many other things. So imagine having cash flow coming in. I talked about legacy every single quarter, and you do not have to pay taxes on that cash flow. Or as of next year, you only have to pay 20% of whatever income. And I don't even know how that works. You got to talk to your CPA about that. But basically what all this means is that within 7 years, we're able to hit at least a 2 times multiple. That means that all the cash flow you get equals your investment. And then when we refinance, you actually get your original principal back. Tell me about the savings account that does that. I don't know if you guys have a savings account that does that, or a mutual fund that'll hold your principal, pay you cash on it, and then give you your principal back. I don't think any of the vehicles that we talked about earlier do that. So we buy specifically below the Sun Belt because since the pandemic, everyone moved south. And they moved to very specific areas. A lot of people moved to Raleigh, North Carolina. They moved to places like Somerville, South Carolina is where we invest. They moved to specific places in Florida and Texas. So we analyze all of our markets to make sure that the rents are actually increasing. And so with all of our markets, we see a 17 to 30% increase in rent. And that's why just since last year, not every year, just since last year, since the pandemic. We also underwrite to make sure that there's job growth. We want to find places in tertiary markets. That means like just outside of the metropolitan area. So it's not in the city. It's a beautiful suburban area. And these are some of the areas that we like. We like Charlotte, North Carolina. It's a 16.9% increase in rents since the pandemic. Raleigh's got 11% increase. Actually, we've seen properties that are even better than that, where the rents are just low because the owners did not increase the rents. And that's a big deal for us because we make money when we can go in, buy a beautiful property that has rents lower than market. We love Orlando, Florida. We love Houston. We love Austin. These are markets that are really, really hot right now. And that's where we're looking. So we right now have a wonderful portfolio that we have an accepted letter of intent on. It's 3 different apartment complexes. And these 3 apartment complexes, one is in Austin, one's in Stafford, Texas, and one is in Katy, Texas, which are the Houston market. So one's in Austin and 2 are just outside of Houston. Gorgeous properties. The Treehouse Apartments, there's 297 apartments. It's in the Parker Lane neighborhood in Southeast Austin. There's studios, 1 bedrooms, 2 bedrooms, 3 bedrooms. It was just built in 1985. This is the oldest of the 3. And net operating income that our investors are going to be receiving, that legacy cash flow I talked about, we are buying $2.4 million in income at that property. We project that we're going to increase because of that little rental gap that I told you about. We're going to be able to increase rents over the next 2 to 3 years to $2.8 million. And so we're raising a total of 24.5 million to buy that income. And we're buying that income until we sell it, and we have no plans on selling. Our plans are to refinance and to keep going. The second property is it's called Waterstone Place. Waterstone Place is 168 apartments in Stafford, Texas. All of them are 3 bedrooms. What's interesting is that these are what they call MHT. So these are manufactured housing. It was just built in 2001, so it's a newer property. And the neighborhood is pristine. It's right next to another beautiful property. In fact, our head underwriter just told me that the Austin property is right less than 4 minutes away from a brand new A-class property that just opened, which is absolutely gorgeous. And I didn't see it when we initially looked at this. Then we have Stone Creek Apartments. It's 297 apartments. We are buying, it was built in 1997, and we're buying 1.8 million. The total raise on this one is 18 million. Altogether, we're raising a total of $58 million to take down 673 apartments. And let me rephrase that. 58 million is buying 673 apartments that have consistent cash flow. Imagine whatever your investment is buying cash flow that these apartments have been there from 1985, 1997, and 2001. They've been producing cash flow through the pandemic. So when you put your money into an asset like this, it's no different than putting your money in your savings account, in your mutual fund. You're literally moving your funds from something that's not paying you well to something that is paying you well. So what's nice about the large multifamily space is we're able to hire property management. We don't handle those crazy things that I was talking about that my son had to deal with and that we're dealing with in New Jersey right now. We don't do any of that. The property man, we're able to hire the best property management, and we're able to get the best possible prices. With my properties, they're scattered all over the place. I've always heard 7 to 8% cost for property management. And we usually, every time we hire property management, it's like the 7 to 8%, plus they have another fee for maintenance and another fee for this and another fee for that. In the large multifamily, it's we underwrite at a 3.5% because it's so many doors, everything's in one spot, and maintenance is a lot easier because you've got a staffed maintenance person that's handled by the property management. And all we have to do is deal with our asset management. So asset management is us managing the property managers. We've been trained, a lot of us on this team have been with Multifamily Mindset, which is the mentor that we get all of our advice from that actually works with us to make sure that we are buying the right types of assets. So this is Ryan Woolley and Tyler Devereaux. Tyler's up here in the top. He's wonderful. And he actually got into this business just 8 years ago. And that's when this education came out. It just came out a few years ago. So it wasn't out before 2008. There was a guy who actually wrote the first book named Dave Lindahl. So if you didn't have family that taught you about how to buy large multifamily, you just didn't know. Or unless you worked at a property management company or you worked somewhere and you figured it out. But these guys taught us everything, and we are so thankful. They're up to $231 million in assets, over 2,000 doors. And as you can see, they're focused below the Sun Belt. Neither of them actually live in any of those states. Tyler lives in Hawaii and Ryan lives in Utah. Actually, Ryan just moved here to Orlando. We also are affiliated with Grant Cardone. Grant Cardone is phenomenal. If you don't know about Grant Cardone, we are working with Grant, and we even are able to pitch our deals to Grant so that he can come on as experience with some experience in return for equity. And we have a few people that we work for that. I just pitched Grant on another deal that we were working on, and he advised us to walk away from the project. It was a wonderful 1,663 apartments here in Orlando. You can see that on my Instagram. He said, you know what, Tené, you need to leave that one alone. I like it, but wait. He likes it, but he thought we should wait on it another 6 months to a year for it to go down a little bit more. That's the kind of advice that we have. We also have strategic partnerships with Vanessa Alfaro, Seth Sundberg. These are just a few of the sponsors. So every time we buy a property, I'm not the one that actually is in the market. We have experienced sponsors that come on board with us. So right now in Texas, we're going to be contacting Vanessa and Seth and say, hey, we want you to handle that. So asset management is actually handled by whoever we're partnered with in that market. We also have a wonderful team, Quattro Capital, that's in our network. Quattro Capital is buying properties also below the Sun Belt. They've got properties in Tennessee, North Carolina, all the areas that I spoke about. These are all in our network. So when you heard, I'm sure you've heard it, don't wait to buy real estate and wait. That has to do with buying, your single family properties. But when you're at this level, you actually can take your 401k and you can roll it over, or if you have a self-directed IRA, you could use that. Again, like I said, you can use those funds, move it from the stock market and secure it in a hard asset. That's what's awesome about multifamily real estate. And you could also do a 1031 exchange. You could also use equity in your property. Think about the equity in your property. Are you sitting on, because I know a lot of people have heard, some people are smart and they've paid off their mortgages, or they got a 15-year mortgage and it's paid off, or they might have used a guy's program and paid down their mortgage. And now they're sitting on a bunch of equity. What's that equity doing for you? It's not making any money. It's sitting there moving with the market. What if you took a piece of that equity out and invested it so that you can get cash flow coming in every quarter? Now your equity is really moving for you. So I want you to start using your brain. Think about, where do I really have money? Because believe it or not, a lot of us have money that we just haven't even thought about. This entire fund is a $25 million fund. That $25 million, as I told you before, is $58 million that's needed to buy that portfolio. However, we only need to raise $5.8 million of the 58. And the reason for that is because we have institutional investors that buy this stuff. Family offices, hedge funds, they want this kind of property. Banks, this is where they're putting your money. When your money goes into the bank, it's getting put into an investment that they can make a decent return on investment. We are now bringing this to you direct. So the next step is basically to go and register at clearvieweastern.com. We have a wonderful investor portal. You can learn more about that Texas deal. You can learn more about other deals that we already have and deals that we're working on, like that Orlando package. Go to clearvieweastern.com and learn everything about all the details and finer details of our paperwork. Everything is in there. You want to click on the investor portal, submit your accreditation letter. You do have to be an accredited investor. Now, here's what the definition of an accredited investor is. If you don't know if you are, don't worry. We have a third-party verification service that actually verifies that you are, that can provide you with an accreditation letter and all that. But you have to make at least 200. It's one of these. You could be an individual that makes $250,000 or more. You could be a couple that makes at least $300,000. You could be a business. You could be a business. You could be a C Corp, LLP, a partnership that has the money to invest and you're accredited. You can get accredited that way. You also could be what am I forgetting? You could be a business. You could be a broker. This is a new regulation that they just changed. If you have a Series 6, 63, 7, you have to read the details. And actually, a third-party verification will check that. But if you are a licensed broker, then now you don't have to meet those qualifications. So if you're a licensed broker and you've got some equity in your house or something, you want to move that over, or however you want to do it to find the money, you could do it and you don't have to have that income or the $1 million. Oh, there's one more thing. If you have $1 million saved in wherever you've got it saved, that also makes you an accredited investor. So there's a lot of ways that you could be an accredited investor. And I think the biggest thing that people forget is that businesses can also be accredited. And so I know a lot of businesses that, are just recently exiting. That's another way. There's people that have businesses that are exiting their business and they need somewhere to put cash. So I want you to think about the fact that literally by the end of this week, everything changes. So what changes is that you don't get 100% tax write-off. And so that 100% tax write-off is a really, really big deal. Our investors have the minimum is 100,000. And if 100,000 will get you a 6% preferred return, and 250,000 gets you a 7% preferred return, 250 or more as an investment.